Hi guys. So today I'm going to talk about the investing cost, the cost of investing. So you guys might be familiar with just commissions and stuff, but and then all these companies now are taking away the commissions, making it zero commissions, or maybe they have a subscription or whatnot. But yeah, there are costs to the trades no matter what. That's how they stay in business. And so I just wanted to go over the different costs and then help you guys see what costs you are actually going to be incurring with different methods of investing. And so I kind of just have a spreadsheet here. I'll give this in the link below. But yeah, there's just random, just here's kind of not random, but here's an overview of random numbers I put in, but and then the results of those random numbers. And so yeah, let's just say we're just opening up our investment account for the first time, and we have $10,000 to open up with. And let's just say we're contributing $1,000 a year to our investment account. And for easy math, we're just going to say this $1,000 is going to be on the front end of the year. So January 1st, we're opening the account with 10,000. We're adding 1,000, so it's going to be 11,000. And each January 1st, we'll just at the very beginning of the market opening, we're going to have it like this, and we're going to also say we're just going to make a 10% return a year, just for the ease of the math here. And then yeah, there's a few other factors that go into investing costs, which are the trades you do per year, or the shares you buy, or the shares you sold, just depending on what method you are using for investing. And that's kind of I just explained through this top table here, and go down to this second table here, and that's just showing you that you can have a price per share. Let's say you have Facebook stock. I think it's around 230 right now, around 200. Or let's just say you have Google stock. Right now it's around 1,400. We're just going to say the stock we're buying is going to be $200. And we're going to say that there's also what's called a bid and ask price of that stock, and so the bid and ask spread, just to kind of briefly go over what that means, is that every time you buy a stock, you are actually going to buy that at the higher price. You're trying to get this stock, and you're going to buy it at the higher price, so it's going to be a little more than the share price. And then the bid is when you're trying to sell the stock, so you're selling it at a lower price. And that's kind of how the market helps the market move up and down the stock price, because then you can, if more people are selling and it's just going below the stock share price, then they're going to just keep on going below that until they can sell. Same thing with buying. If the stock price goes up because a lot of people are buying it and not enough people are selling it, so they just keep on raising the price until they're able to have someone sell it to them. And then here's kind of a newer thing. I mean, it's been around for a few years, but more and more investment companies are giving this option called fractional shares. And so you can just buy a piece of a share, and you could do like half a share, a quarter of a share, a third of a share, whatever amount of money you put in. They'll just calculate how many shares that is, the amount that would be, and so you don't have to worry about the share price anymore with this new way of investing. You can just look at you could just say, oh, I'm going to invest $1,000 a year, and and I don't care what the share price is. I'm going to put into this investment, and just going to do $1,000 per year, and you don't even have to worry about like if you, let's say you only had like $50 and you would invest in Google, which is $1,400 stock right now. It's probably going to be higher when you guys are watching this video, but yeah, so yeah, you would just put in the $50, and that would be a fraction of the share. Just for simple math here, I'll just show you what that would be. Let's say it was a $1,400 stock. Then you would get a 0.035 of a share. So not that much, but still, if you're looking at just having a percentage of your money in different areas, that's also a nice thing about the fractional shares. So you don't have to worry about having if you wanted to buy one share of Google and $1,400 was just too high of a percentage of your total investing money, then you can just have that be at a lower fractional share, just at the amount you have for it. Yeah, so just depending on the share price, the bid ask, the fractional share, the bid ask will adjust to that based off the bid ask of the original share price. So yeah, we got a few different methods. This third table here is just going over the different methods of it. The fourth table down there is just for me to look at different examples of playing with the numbers I have as inputs. But yeah, so let's say you have a financial advisor, and he goes off the old school method of commission per trade. He doesn't do a percentage. Some newer, more and more doing the percentage. But now, if you had this old advisor just doing off the cost of per trade, then they're just going to do it based off the cost per trade. It doesn't matter how many shares you sold or bought. Then you don't have to. You may have to worry about the bid-ask price. So this is the kind of controversy I see here, is that some I've talked to quite a few advisors. Some of them say that they're not doing the bid-ask, that they're just saying we're just putting it at that we're getting it at the price of the stock. And do I believe that? I don't know, but it kind of, like, if they do, I mean, what the bid-ask spread really is that's the payment, the commission you give to the people to trade for you on your behalf. So I can see some type of company just saying, oh, we're just going to charge a flat amount per trade. You don't have to worry about the bid-ask spread, and so you don't have to worry about that being too high for just depending on your shares, because it's per share. So there's per trade cost and per share cost when you're dealing with an advisor that takes commission. So we'll just leave it like that. So for this simplicity example, you could definitely play with this table on your own. So yeah, so right now I just have that as $20 per trade. Financial advisors are usually more expensive than the other brokerages, and a lot of them are going to zero commission trades. So they just really make the money off the bid-ask spread. So advisor fee. So if you have a financial advisor that does the fee method, this is kind of like they just take a percent of your balance. So if you have $10,000 in your account and they take 1%, then that's going to be $100 per year. So they just charge the percentage per year, and then there's also the fee per share. So like if you buy two shares in a year, and the bid ask spread was 50 cents, that means that that the brokerage that buys it for you would make $1. Let's see, financial planner. So there's some financial. There's quite a few different financial advisor types and financial planners. There's some that do the commission thing, and then there's also some that do the annual fees thing. There's some that do both, and this one kind of focuses more on your budget and helping you with your financial plan. The other ones tend to focus more on just the investments, but all of them can help you with all your financial planning. But in this case, we're just saying that this financial planner just charges an annual fee, $300 per year, and then the brokerage that actually sells your trades and buys your sells and buys your shares for you takes that bid ask spread. $0 commission, same thing with the bid ask spread. It's just they don't charge anything else, so they just really make that money off the bid ask spread. There's also some other methods. I know Robinhood, they use the method of selling your trade to another brokerage to sell or buy your shares for you on your behalf. So they don't really actually make their money off the bid ask spread. They sell this transaction to some other brokerage. And so that example is not even here, but that doesn't matter because we're just talking about your costs, not the way they make money. But I just went on a tangent there. But anyway, because the reason why that other brokerage, not Robinhood, but the other brokerage really wants to buy that business from them is because they know they're going to make a lot of money off that bid ask spread. So it just depends on how many shares you're buying and the spread that actually exists, what that's going to be, and so that's Robinhood's method. I know the other big brokerages like TD Ameritrade and Fidelity, Charles Schwab, they usually do the brokerage services themselves. Subscription, so kind of the same idea as the zero commission one, except they just have a subscription for their service. There's a few examples out there that do that. Acorn. By the time I say these, everyone's going to just go to the zero commission probably, because that's the most appealing for the audience, because they're like, oh, zero commissions, oh, it's free, but not really. So yeah, you just got to pay attention to that bid ask spread and what you're actually paying. And if you do have an advisor that really says that their only commission, or a service that says they're only going to be flat per trade, they don't care about the bid ask spread, then that might be worth looking into, just depending on the numbers and how the volume of your trades. But at the same time, I really don't believe that they're really doing a no bid ask spread, just because that's how the market moves. I mean, maybe they do a smaller bid ask spread. I could see that, but no bid ask spread, that's kind of hard to believe for me. But yeah, let's just I'll do some examples, and I'll also show you this kind of how this bid ask spread calculates down here, so that you can play around with this yourself if you want to. So yeah, this example, it's the bid ask spread is 50 cents, and if we change this to 1,000 for this share price, then the bid-ask spread changes to $2.50. So you can kind of see how that can play out. It's just the same, taking that proportion and the same proportion and applying it to the $1,000 instead of the $200 share price. And so yeah, let's just play around with these numbers here and see what happens. So let's say I'm gonna do 3 trades per year, but I buy 50 shares of something of this stock, just this one, just to make this simple. And let's say I sell 1,000. I did 3 trades and I sold 1,000 shares and I bought 50 shares. So that means, like, I did probably, let's just say I did one buy at 50 in the year in January, and then in August I did one sell of 500, and in December I did another sell of 500. So that's 3 trades right there. And you could see how potentially the service that just does commission per trade doesn't cost as much compared to these other ones. Let's just say for argument's sake that, yeah, we don't believe them. They're not actually going to be doing this method. But let's just say they have a smaller one. Let's just say 10 cents, and let's just say that this is $1. So you could see that jump up, but still, it still could cost less, and that's why you kind of want to look into it and ask them for the actual facts instead of them just telling you, oh yeah, we do this. But more realistically, if you're let's say you're a day trader, actually, let's just throw this on the other side, and we have the same amount, but you're day trader, so you do hecka trades, and let's just say you do I don't know, 1,000 trades per year, then yeah, you wouldn't even day trade with a broker. It doesn't even make sense, because the broker, or the financial advisor, because they're just a middleman for you. And if you're day trading, you're really trying to just do this on your own and making the decisions. A lot of financial advisors, if you ask them that you want to buy like Amazon shares, they'll just let you buy the Amazon shares. They don't like block you from that, but they're really so it just depends on the financial advisor. You might tell the financial advisor that like to help you out when there's like a market crash. You're like, okay, don't let me sell if there's a market crash. Market crashes, you're like, oh crap, I need to sell. And then the financial advisor's like, oh, don't sell because you told me not to do this. And the financial advisor knows better to not sell if there's a correction, because then you lose the money. So yeah, let's go down some here with the trades, which we're kind of more, we trade quite a bit, 50 a year, but not at the day trader level. And let's put down these shares. Let's say I barely bought anything. Let's just say I bought 5 shares and I sold 2 shares. Well, you could see at this, oh no, that doesn't even make sense. Sorry guys, I'm not thinking. Maybe it makes sense if this was the net. No, it doesn't even. Still, 50 trades. Let's go down to like 3 trades again. Or I just want to make this one higher. So let's go to 5 trades. So you could see how, I mean, the advisor fee's not really working out for you at 5 trades. Definitely the financial planner. I mean, taking into account that they're helping you with other things, and the fee might be different than that. And so I just threw that in there. Commission, $0 commission, killing it at this level. Let's throw this up. Let's just say you did do 10 shares or 20. You bought 20 shares. Let's go 50. Let's go to 50 and 5. Alright, $0 commission, killing it still. And but the fractional shares, no, because the price. Okay, so let's do another example. Let's just say this is. We'll just kind of create the opposite effect of this. So $1,000 and 200. No. I'm gonna change these first so I can. 9875, 1,125. And everything's freaking out on me. Alright, here we go. We did the opposite. So it creates the opposite effect. So yeah, fractional shares, because you're not selling as you're not putting as much money in, it has a lesser spread, and so the spread is $28. We can raise the commission. I mean, that's why you kind of have to do your research to find which one's actually worth it. I know there's still brokerages out there that do $30 per trade. There's brokerages out there that do $50. So you just have to make sure you're getting a good deal on stuff. And then again, yeah, they're winning just because they're saying that there is none, but in reality I think there is one, but it's just at a smaller amount. So feel free to play around with this table, but yeah, you can see how in total, if you bought it for the share price, then it would be higher, or not higher, but higher compared to the fractional. That's what I'm trying to say. So any more examples we should do? Maybe I should show you the chart here and how things play out over a time period. So 10-year comparison with just per year type graph with the different methods, and this is a 20-year comparison, but at the year 20, what amount it amounts to. And so, I mean, in the grand scheme of things, yeah, this one financial planner looks like it could be like a 20 grand difference from the $0 commission. $0 commission winning with this model here. You can see how the spreads out over time. Subscription winning looks like the other few here is going to be in this one. I could play around with the different things again. So let's say that you could really have fun with this. You could say we put this back down to $20. Means that looks like the advisor commission one got a leg up on the other two by a small fraction on this graph. And let's say I did a $5,000 contribution a year. The more contribution you do a year, the less effect the financial planner has on you, and the more. So you see the financial planner shoot up, but It's still still losing to the other ones. Um, let's go with 200 trades a year. Advisor commission is down, way bad, because it's per trade instead of per share. Let's get that down to 50. So now it's still losing because it's down to 50. Let's put the shares bought up to 100, and keep in mind it. I mean, if you do, there are other things you could do, like no fee mutual funds and ETFs. ETFs are priced at commission like a stock, but mutual funds may be free. You could make it so you don't have to worry about it, and some companies have a deal where if you just put in the same repetitive amount a month, you could adjust that. But if you commit amount a month, then they'll take away the fees too. So they might want to look into that. So yeah, we bought 100. Let's put this down. Let's change this back here. Okay. And say you sold 50 shares, still losing. Let's say you did 5 trades. Now you see how the advisor wins, or the advisor commission wins. Yeah, man, this is just, it's crazy how you could just play around with this. So I'll give it to you guys now.